Long-term asset disclosures are an essential component of financial reporting because they provide detailed information about the nature, valuation, and accounting treatment of a company's non-current assets. The program emphasizes that disclosures supplement the primary financial statements by explaining management assumptions, accounting methods, depreciation policies, impairment testing, and significant changes affecting long-term assets. These disclosures improve transparency and allow analysts to assess asset quality, operational efficiency, and future earning potential more accurately. Long-term assets typically include property, plant and equipment, intangible assets, goodwill, and investment assets expected to generate benefits over multiple accounting periods. Effective disclosure enables investors and creditors to evaluate both the reliability of reported asset values and the sustainability of corporate operations. Property, plant, and equipment (PP&E) disclosures provide important information regarding asset composition, depreciation methods, useful life estimates, and capital expenditures. Companies disclose whether assets are measured using the cost model or revaluation model under IFRS. The program notes that US GAAP generally requires the cost model, while IFRS allows either cost or revaluation approaches for classes of long-term assets. Analysts review depreciation methods carefully because choices such as straight-line or accelerated depreciation affect profitability and asset values differently over time. Disclosures regarding maintenance expenditures, capital investments, and asset retirements also help analysts assess operational efficiency, growth strategy, and future capital spending requirements within the business. Disclosures related to intangible assets and goodwill are particularly important because these assets often involve substantial estimation, uncertainty, and management judgment. Companies must disclose the nature of intangible assets, amortization methods, useful lives, impairment testing assumptions, and carrying amounts. Finite-lived intangible assets are amortized over their expected useful lives, while indefinite-lived assets and goodwill are tested periodically for impairment. Analysts examine impairment assumptions carefully because changes in market conditions, technological developments, or strategic performance can materially affect asset values. Large goodwill balances or recurring impairment losses may indicate acquisition risks or overly optimistic valuation assumptions. Detailed disclosures therefore improve analysts' ability to evaluate earnings quality, acquisition effectiveness, and long-term business sustainability. Long-term asset disclosures also provide insight into impairment charges, write-downs, and reversals when applicable. Companies disclose the circumstances leading to impairment recognition, the amount of impairment loss, and the methods used to estimate recoverable value. Under IFRS, reversals of impairment losses for certain long-lived assets may be permitted if conditions improve, while US GAAP generally prohibits reversals. Analysts review these disclosures because impairment losses often signal declining operational performance, technological obsolescence, or strategic miscalculations. Repeated impairments may also raise concerns regarding management effectiveness or financial reporting quality. Understanding impairment disclosures helps analysts distinguish between temporary market fluctuations and more serious long-term declines in asset productivity and economic value. Disclosure requirements for leased assets, investment properties, and natural resources further enhance financial statement analysis. Companies disclose lease obligations, depreciation of leased assets, and assumptions related to lease terms and discount rates. Investment property disclosures explain valuation methods and rental income generation, while extractive industries disclose reserve estimates, depletion methods, and environmental obligations. These disclosures allow analysts to assess operational risks, future cash flow potential, and long-term financial commitments more comprehensively. Because long-term assets often represent substantial investments requiring significant future maintenance or replacement, understanding related disclosures improves evaluation of capital allocation strategy, solvency, and financial flexibility across varying industries and economic conditions. The analysis of long-term asset disclosures is essential because accounting standards permit considerable management judgment in valuing, depreciating, and impairing non-current assets. Disclosure information helps analysts evaluate whether reported asset values reasonably reflect economic reality and whether accounting policies are aggressive or conservative. Analysts combine disclosure analysis with ratio analysis, cash flow evaluation, and industry comparisons to assess asset utilization, profitability, and operational sustainability. Transparent and detailed disclosures improve investor confidence and support more accurate valuation and forecasting decisions. A strong understanding of long-term asset disclosures enables analysts to interpret financial statements more effectively, identify potential reporting risks, and evaluate a company's long-term competitive position and financial health within global capital markets.